Wyckoff and how Wyckoff actually was derived, as well as how we can use it in our everyday trading. So Wyckoff was originally derived by a man known as, give me one moment, many people are joining. So it was originally derived by a man named Richard Wyckoff. And let me actually pull up a website that you guys can go look and study, which is actually a very good resource. So it was actually derived by a man called Richard Wyckoff. Now he was originally a stock trader. So a lot of people think that one of the biggest weaknesses of Wyckoff is that Wyckoff was originally a stock trader. This isn't really the case because, as we know, the markets move on an algorithmic basis. Since they move on an algorithmic basis, what they need to do is they need to follow a certain pattern. Because of this, we know that the patterns that have worked in the past and can be adapted to be used institutionally can also be used in the future to and can also be adapted to different styles such as smart money and liquidity theories. So essentially, there is a couple basic things that we're going to cover. And let's actually pull out the whiteboard now. So I can show you guys the basics of Wyckoff. So Wyckoff is a type of chart pattern, but it is also mixed into different phases. So essentially, we know that the market moves in two phases, right? We know that it moves between compression, right, which is the consolidation or the consolidation phase, and then it moves into expansion, right? So we know contraction, and we also know expansion, right? Since we already know both of these, we have to realize that the expansion phase is mostly characterized by order blocks, is characterized by liquidity runs, is characterized by a lot of different hold on, I'm trying to handle a bunch of people joining at the same time. Give me one moment. All right. Sorry about that. Okay. So we understand that Wyckoff moves in different phases, right? And how does Wyckoff actually move in these phases? So we know that the market moves in compression uh, into expansion, but there are two different types of compression. Well, there are multiple types of compression that the market actually goes into before it actually expands, and that's where Wyckoff actually came into play, because Wyckoff developed and understood that a lot of these different types of compression and expansion were just the same. They were literally just the same schematics or patterns over and over. That's really what schematic just means. It's just the same patterns over and over. And because of that, they understood that. Okay, so they understood that the market will repeat these patterns and it will leave a certain breadcrumb to try to move their own money in a certain way. So let me give you guys an example. There's going to be certain phases. So let's start with the phases, right? The phases are going to be accumulation, and distribution. Now, for a lack of a better word, we're going to name these in what direction they're going to go into, okay? So accumulation is normally known for its bullish movement after it. It's bullish expansion. So it's going to characterize a bullish expansion. Now, so for the people that don't know what bullish just means a buy, right? So bullish is just a buy. You can kind of just label that at the top as a buy, right? It's the exact same thing. Now, distribution is going to be the exact opposite. It's going to be a bearish expansion. It's going to be a sell, right? Now, we know where the general direction of these go. So now that we understand where the general direction of these go, we're going to have to see them in action. Because if we don't see them in action, we're just explaining a theory, right? So let's go ahead and show you guys what they actually look like. So firstly, let's say we're coming up from a bullish trend, right? Or a bullish move. Now price starts consolidating. Okay. So price starts consolidating. Many traders would look at consolidation and they don't like trading consolidation. There's many reasons for this. Many traders are taught not to trade consolidation at all. Meanwhile, other traders are taught to trade breakouts. And banks have deliberately uh, they have deliberately moved their money in such a way that they're going to capture as much liquidity as they can. Now, what do I mean by capturing liquidity? Capturing liquidity in a very simple terms is stopping people out and getting as much money on their side as they possibly can. So it's kind of a game of stopping people out, right? It's a for very simple terms. So there are going to be various phases in this market, and we're going to actually go back to that resource that we looked at earlier, and we're going to see it very quickly. So we're going to go down here toward the events, right? So the first event that we're going to do is we're going to see distribution. So the first event that we see here is going to be distribution. Let's actually zoom in a little bit so we can see a little bit better. So firstly, we see that we have this bullish trend moving upward, or this bullish move, right? And it goes up. Now it's firstly characterized by the PSY, or the preliminary supply. Now remember, where do you find Wyckoff? So before you even start using Wyckoff, you know where to find it. Okay. So normally where you want to find it is on higher time frames, normally the 4 hour, the 2 hour at least, right? Or the 1 hour. Usually you're going to see different schematics on those time frames. Now, because of this, you're going to want to be careful with how you use it, right? Because if you start using Wyckoff and let's say after this class, right, you hop off the class and you start trying to force these schematics, they're not going to work out for you. So you have to be very certain that you understand how these schematics work. Firstly, let's go ahead and see what the different phases are. So the first one is preliminary supply, like I said. This really is kind of the first sign of the trend stopping and consolidating, right? Or the move stopping and consolidating. So after every move, right? After every impulsive or institutionally sponsored move, meaning that the banks put their own money into the move, and then they, let's say they take it from point A, which is down here, right? Let's actually annotate. So let's say they take it from point A down here all the way to point B up here. Sorry, up here, right? If they're going to take price from point A to point B, they're going to have to slow down at some point, right? It's just like a car. So when a car starts driving up the road, right, and it needs to stop at point B, you're not going to stop. You're not going to start pressing on your brake right at point B. You're going to start pressing on your brake a little bit beforehand. In this case, that's the PSY. So think about it like the bank starting to press on the brake, right? So that's when they start needing to consolidate. So afterward, we're going to see the BC. Now, you guys can write these out in your own exercises because that way it's a little bit easier for you to understand, right? And they are the BC is known as the buying climax, right? So you see it down here, it's the buying climax. Now, the buying climax usually is a spike of volatility that establishes the range, right? So you want to keep an eye on it afterward. So remember that you don't want to be I need you guys to actually write this down in your notes, right? You do not want to be trying to spot or see, right, or trade a schematic without it making a at least 50% of the schematic first. Okay, I need you guys to write that down. You don't want to be trying to spot a schematic without at least it making 50%. Usually it's more, but without at least 50% of the schematic done first. Why? One of the biggest mistakes that I see newer traders making is that they see the PSY, they see the buying climax, they see the automatic rally and the secondary test, and they immediately think that it's accumulation or distribution. It's not either right now. You're going to see this, like the first half of it, you're going to see it a lot in the market. Okay. It doesn't necessarily mean that just because you saw one or two phases that it's already a completed Wyckoff schematic. You only want to trade it around here, and I'll explain that in a second. So the AR, so the AR is known as the automatic rally. Now, the automatic rally, what it does is essentially once you establish your range by placing the buying climax, the automatic rally is going to be the immediate reaction from the banks starting to pull back and assess whether or not that's where they want to actually, stay in terms of their pricing points, right? So the AR is essentially part of the group of the range, right? So it's the bottom of the range. Now, the one afterward is the ST. Now, some people may be asking, what is the ST? So it's the secondary test. And the secondary test establishes the range, right? So it establishes the range. Now, why does it establish the range? It's very simple. Because once you have this buying climax up here and you have this automatic rally down here, that creates the point A and point B, right? That the range is going to be established within. Then afterward, the secondary test confirms that you are not just having a pullback, right? So normally, if we didn't have any of the schematic, right, and we just had the buying climax and the automatic rally, you maybe would think, hey, this is an order block, and it's going to shoot up, and it did, right? And from this point onward, you when it starts reacting again and creating and establishing the range, and the range really just means consolidation. Okay, range really just means consolidation. So once you've already established your range, you have this extra confirmation of the secondary test telling you, yes, this indeed is starting to be a range. Do we have any questions so far? So before I continue, do we have any questions so far? Is everybody understanding? I would rather you stop me now and ask a question than you trying to use it on your own and not being successful with it. You guys can go ahead and chat. We don't have mics enabled. You guys can just go ahead and type it in chat if you guys have a question at any moment, by the way. So if the ST pushed above the BC, so if the secondary test pushed above the buying climax, would that negate this being consolidation? Yes, because at that point, if the secondary test pushed up above the buying climax, unless you saw something later on that established the range, that's not a range, right? Because you're not staying within your boundaries. So essentially, the AR and the BC are your kind of boundaries, right? They don't have to, like, if the ST goes above the BC by like 5 pips, you don't really have to pay attention to that. But when it just blasts above it, then yes, it would be negated. Any other questions? Just drop them in the chat if you guys have any other questions. Okay. So the next phase is going to be the SOW. Now the SOW, what's the AR? It's the automatic rally up here. Do you guys see the little annotations I'm making? It's these right here. It's the automatic rally. All right. So, oh, whoops. So the phase afterward is known as the SOW. Okay. The SOW is the sign of weakness. Now, this is one that is very unique towards distribution. Okay. So this is unique towards distribution. This will not appear in accumulation. Okay. And this is what is known as the sign of weakness, or the SOW, right? The sign of weakness. And the sign of weakness shows willingness to go lower. It is a prod by the banks. Okay. So the sign of weakness, let me explain it a little bit more thoroughly here. The sign of weakness is a willingness from the banks to actually go lower. What do I mean by it's a prod by the banks? Basically, the AR, like I said before, is supposed to be the floor of the range, right? So it's supposed to be the floor of the range. Now, the SOW is that fake breakout, right? The SOW is a poke by the banks trying to break the floor and seeing if they need more money, like if they need to put in more lots to actually break that range, or if their buying or selling power is strong enough to break the range, right? So basically, when the banks create an SOW, it's because they had enough power to actually break through the floor of that trading range, right? Now afterward, sorry, we have a question. What days would you look for Wyckoff schematic? Uh, does it does certain days respect schematics more, even though it's a constant cycle? No, I don't have certain days that I look for them more often. However, if we think about like the week in terms of volatility, we know that Tuesday into Wednesday has a lot of volatility, and Wednesday into Thursday also has a lot of volatility. So I would focus on on that section, right, on those two sections. So from Tuesday to Wednesday, and from Wednesday to Thursday, if you're really looking for a schematic to form the tail end of it, because that's when there's more volatility, but you'll find it at any time. And I'll go into this a little bit more in depth when we go into the lower time frame Wyckoff. So right now we're thinking of this like we're looking at it on the 4 hour. Forget about lower time frame right now. Okay, we're just thinking about it like it's on the 4 hour time frame. All right. What time frame do you usually look for schematics? So the beauty about Wyckoff is that price is fractal. Now, what do I mean by price is being fractal? Basically, what I mean is that price is going to be all the same, right? So if we're on the 1 minute time frame, let's go to, like, let's say, oh whoops, we can't get out of here. So let's say we go to like gold on the 1 minute, right? If we go to gold on the 1 minute, it's going and it moves up 50 pips, right? That means that the 5 minute has also moved up 50 pips. And the 10 minute has also moved up 50 pips. The 1 hour has also moved up 50 pips. And the 4 hour has as well. So if you're creating something on the 1 minute, it's going to, excuse me, invariably affect the 5, 10, 15, 20, 30, 1 hour, 4 hour. So basically, whatever you create on the lower time frames is going to affect the higher time frames. So price is fractal, meaning that price is all the same. Whatever happens on the 1 hour is going to be expressed later on the 4 hour. So to answer your question, what time frame do you usually check for your schematic? You can check on any time frame. That's the beauty of this. But I would suggest you look on higher time frames for more efficient moves. And we're going to go over some live examples later on today so that we can actually understand what I'm actually saying. If banks don't have power to break that range at SOW, they proceeded regardless. This would result in a much weaker drive down than they were after, right? So if the banks do not have enough power to actually create the SOW, instead of the SOW happening here, it would just reject off the AR and it would come back up to another range, or it would reject off the AR and continue up to the UT, which is our next phase, right? So the UT is the upthrust. So the upthrust. And this is a taking of liquidity by banks to uh, collect higher entries. So this is a concept that you guys will learn later, which is power of three, right? But at the same time here, we're expressing it a little bit differently. So in this case, the upthrust is simply a taking of liquidity by banks to collect higher entries. So for example, let's say that you guys as traders, right? Or let's say you guys as customers in a store. Let's say you guys are going to or you guys are going to go buy a very highly priced item, right? Let's say you guys are going to go get a PS5 or a new TV, right? Would you guys like to buy that at premium price, or would you guys like to buy that at discounted price? So answer me that, you guys. You're going to want to buy it at a discounted price, right? Exactly. You're going to want to buy it at a discount. So because of that, right? Because of that, the banks think the exact same way in terms of price. However, give me one moment. However, when it comes to bank pricing as well, we want to think of it the same way. However, let's say you are selling an item. Let's say you're selling an item. And because you're selling that item, you want to get as much money as you possibly can from that item, right? So let's say you are selling a house, right? And would you want to sell that at a premium price, meaning like a higher price than what you bought it for, or would you want to sell it at a discount or at a loss for you? Right? You want to sell it at a premium price, right? So think about it the same way. Distribution and accumulation, both being schematics, they are the banks preparing themselves for a massive move in a certain direction. Okay, so if you guys are taking notes, I'd like you guys to note that down. Wyckoff schematics are simply the banks preparing themselves, prepping themselves to make a move to a certain direction. And the schematic phases, meaning like the preliminary supply, the buying, climax, automatic rally, secondary test, sign of weakness. Remember, you guys really need to memorize only a couple of these. The rest are for you to understand why. Okay, and I'll get to which ones later on. So does anybody have any questions that you guys would like to ask at this point? Any questions? Sorry, I'm looking down at my phone for all the questions. Can you repeat the thing about banks? Yeah, sure. So just as you would sell an item, right? Like let's say you're selling like a TV or a house, right? So the writing down in our notes. Okay, yeah, no problem. So the thing that I wanted you guys to write in your notes is Wyckoff schematics, whether it be accumulation or distribution, are simply the banks, is the breadcrumbs of the banks preparing themselves to make a massive move in a certain direction. So in distribution, right, it's the banks preparing themselves or leaving breadcrumbs of their actions, of their financial actions within, the market algorithm, that it turns out to look like this, right? It turns out to look like this. So the result of their actions looks like this because they're preparing themselves, they're preparing their money, their liquidity to actually make a giant move towards the bearish direction. Now, if you're looking at an accumulation, which is a buy, it'd be the exact same thing, just they're preparing themselves to make a massive buy. What if you didn't pay attention to Wyckoff? I mean, if you didn't pay attention to Wyckoff, you can trade without it if you'd like. But I'd suggest that you do take a look at Wyckoff because it is extremely helpful, and it's very helpful for you to spot entries with very low drawdown with Wyckoff. Can the SOW also be a breaker? Uh, yes, it can, but well, no, not in this case. It would not be a breaker per se. It depends on the situation. It really depends on the situation because in this case, it wouldn't be a breaker. Like right here, it wouldn't be a breaker. but we're going to keep it simple because this is a beginner class. So if you want to DM me with an example, you definitely can, and I'll definitely answer it for you. But since it is a beginner class and most people don't know what a breaker is, we're going to keep it simple and just stick to Wyckoff. Okay. So as we continue on, let's memorize the pieces of the schematic that we have so far. Right. So far, what do we have? We have the preliminary supply, right, which is kind of like the pumping of the brakes of the banks, right? The buying climax, which is essentially the highest point and the top of the range, right? The ceiling of the range. We have the automatic rally, which creates the floor of the range, right? And it creates the um it creates essentially the floor of the range, right? And then we have the secondary test. The secondary test establishes the range. So it confirms whether or not you're in a range or whether or not you're just in a, normal bullish move in this case. Um then we have the sign of weakness. The sign of weakness is the banks pushing to go lower and checking whether or not they need more monetary power, meaning they need more money to go down, or if it does create the SOW um, successfully, then you know that banks have the power to break beneath the previous floor, and they will be able to collect liquidity before making their way down, right? So we have those so far. Then we also have the upthrust. The upthrust is the taking of liquidity to collect higher entries. So think about it this way: the banks are about to sell a bunch of their money, right? So let's say that since they're about to sell a bunch of their money of a certain currency, right, depending on the currency pair, what they're going to do is that they're going to take this money, right, and they're going to push price higher so that when they sell that certain currency, they get more return off of it, right? And then whatever other currency they buy, because it's currency exchange, right? So you're selling one and buying the other. Because of that, now you got a lot of profit from the currency you just sold because you pushed price higher before selling it, right? And then they're also grabbing the other currency and they're grabbing it at such a point that they also make profit from that position, right? Does everybody understand what I mean by that? So let's say this would be Euro USD, right? If we say that this is Euro USD, banks in this case are going to be like, if they're pushing price higher, they are going to be buying more euros, right? And they're going to be pushing price higher because at this point the euro is stronger than the dollar. So when they push price higher, they're going to be strengthening the euro so that they push it higher, right? And when they reach towards this peak, what they're going to do is they're going to get rid of that currency, right? Because they sold it at a very high point, therefore valuing their investment upward, right? And then when they get to this point, since it's a currency exchange, what they're going to do is they're going to now buy the US dollar, right? And they're going to strengthen the US dollar. Since they're going to strengthen the US dollar, it's going to fall, right? The cross is going to fall. And that way they are making money both ways. They're making money off the buy by originally investing euros, and then they're going to push it up to a certain price where they can sell, take that little bit more money, right? Take that maximum amount of money that they can grab, and then they're going to take the USD and they're going to push it. They're going to push the cross lower. Does that make sense? Does everybody understand that so far? Okay. Does anybody have any questions so far? Let's get to phase E in a little bit. All right. So if nobody has any questions, we're going to go ahead and continue. So we have the UT, right, which is the upthrust and the taking of liquidity because they push price higher, right? They push their, just for a lack of a better term, they're going to push their product that they want to sell higher, right? So that they could sell it at a higher price. And then from there, we have one more liquidity run. We have one more liquidity run, which is known as the UTAD, or the upthrust after distribution. Upthrust after distribution. This is also known as the spring, right? Some people will call it the spring. Now, this is basically the last move that takes out anybody that's already in this trade, right? So it's the final liquidity run. It breaks through the previous highs. So essentially, why the banks create the UTAD, or the upthrust after distribution, is to take out as many players as they can from the market to then push price lower. And they're also trying to push price one little bit higher up so that they can sell their asset for much more money, right? So just like so essentially, if you had control over the market, let's say you're buying gold coins and you're looking to sell those gold coins. If you had control over the market, you would push price just a little bit higher or a lot higher, right? And then sell your asset. Now, once you sell that asset, price is going to fall, right? So if you had control over the market like banks do, right, for the most part, what they're going to do is they're going to push price just a little bit higher to up value their asset, right? And from there, they're going to sell their asset. So from here, from the UTAD, or the upthrust after distribution, it's to collect more premium selling opportunity, or selling entries, right? So do you want to sell it? So like, let's say, for example, let's go to, well, we can't because we're stuck in this right now. But let's say, for example, you wanted to sell gold, right? Or let's say you wanted to sell GBP USD. Are you going to sell it when it's already moved 40 pips down, or are you going to sell it when it's right at the top? Well, obviously you're going to sell it when it's right at the top, right? You're going to sell it when it's right at the tip top because you want that sniper entry because you get more money. It's the exact same thing for banks. They want the exact tip top. So what they're going to do is they're going to move price just a little bit higher to get more premium selling opportunities. And after this, we have the test, right? Let me open the chat really quickly. Okay. So afterward, we have the test, right? Now the test is very interesting because the test actually establishes change in order flow. Can everybody hear me okay? Yeah, okay. All right, cool. Sorry, my earphones just died for a moment. So the test establishes change in order flow. Now, what do I mean by it establishes change in order flow? Basically, it establishes the change from a bullish, from a bullish movement into a bearish movement. So as we see here, we see the peak up here, right? And then it goes below and it holds that peak. Let me allow some people in. Some people are trying to join and they aren't able to. Give me a moment. There you go. That should work. Is the test our entry? The test is not the entry at the moment, right? The test is going to be, well, the test can be your entry if you feel like you want to catch it, right? But what I suggest being the entry would be the last point of supply, which is our next, which is our next phase. So the test is to establish the change in order flow. Now, what is the change in order flow? So once you have this high, the test is going to drop, right? And then it's going to come back and retest the high. If the high is broken, then we obviously know that this is not distribution yet, right? So this has not even been established as distribution yet. And this is exactly why I say that your entry should be around the LPSY rather than the test, because the test a lot of times is not reliable. And if you want to get a very low drawdown, high precision entry, I would suggest you to go for the LPSY rather than the test, because the test establishes bearish order flow in the sense of it holds the high, right? Meaning that it does not go past the high and it continues lower. So it starts creating that downward movement. So as we continue, we're going to go back down as we see here, and we're going to cross into the LPSY. Now, the LPSY is what we want to be paying attention to, right? The LPSY is the last point of supply. Key point to test the lower lows. A key point to the test is the lower lows. So I'm guessing you're saying like the important part about the test is the lower lows. So yes, so as we see here, right, the test retests the upthrust after distribution. A lot of times it can be a lot larger, so it can fall, all the way down to here and then come back up. Yes, but it establishes bearish order flow, meaning that it essentially says, "Hey, we're not going any higher. We're going to stay low, and then we're going to retest at the LPSY." So the last point of supply is where banks start banks stack more entries. It's the last point of supply, right? It's the last point where banks, like, it's the last point before the drop off, basically, right? It's the last point before the drop off. So as we see here, right, we're going to have the UTAD, the test, which creates the bearish flow, right, and then from there we're going to have the LPSY. Now the LPSY a lot of times is meant to test and mitigate the actual test, right? So what are they going to do? The LPSY is meant for banks to push up and get more stacks of more selling entries, right? It's meant to stop people out who already have, their stop loss at break even. But more so than that, that's more of like a side effect. The actual reason why they push up again for an LPSY is mostly to get again back up into that premium pricing, back up into that higher pricing, so that they can enter sell positions a lot more from, they can enter more sell positions from a higher price. So if I gave you the option from, stacking sell entries down here or to stacking them up here, you would more than likely tell me to stack them, higher. And that's exactly what is going on with the banks here. They manipulate the market so that they get another push up to stack their entries at the very top so that they get as much money as they possibly can need. Now, there can be multiple LPSY, right? There can be multiple LPSY, just as well as there can be multiple SOWs or sign of weaknesses, right? But your entry should be around the LPSY, right? Your entry should not be trying to catch the UTAD. It should not be trying to catch anything like that. It should be trying. It should be waiting for the actual schematic to show its hand, and then from there you're going to actually hop in on the trade once you've actually seen the banks make the UTAD, the test, establish bearish order flow, and then come in for that snipe that you need at the very last point. Let me is anybody typing in the chat? I can't see it for some reason. But either way, those are the notes that you're going to need for distribution. So if you guys haven't already, you guys can take a screenshot now, and it will have, all the little notes beside the actual phases. Okay, so we're going to go ahead and take a screenshot of that. So has somebody at least taken a screenshot and we can share it with our peers? All right, awesome. Awesome. Okay, so now that we have this, right? Now that we have these, this was just distribution. Now, what do I mean by just distribution? Distribution is only one, right? We're going to share the same, basically the same first couple, right? So the PSY, buying climax, automatic rally, secondary test, it's just going to be flipped, right? So how can you tell if officially if it's an LPSY? What does it look like? Let me try to find you an example. Give me one moment. Try to find you a good example for this. So what you're really going to be looking for is you're going to be looking for an order block. You're going to be looking for NZD CAD. Okay, cool. Let me try to check that really quickly. Awesome. Oh, the weekly? Okay. Let me try to check that. Oh, very good. Okay. So let me actually pull out one of my older. Give me one moment, guys. Okay, here's an example. Let's go ahead and replay this. So let me see. Let me actually put you guys back up here. Awesome. Okay. So this right here is a good example. This is an older example, but it's a very good one. So this, as we see here, is distribution, right? We have our buying climax. We have our automatic rally. We have our secondary test, right? It didn't blow past the buying climax. We have our preliminary supply, right? And we have our position going up higher, right? We have our up thrust, and then we have our up thrust after distribution. So after this, we have the test, right? So now the test, what do you guys think the test, or what comes after the test, basically? The LPSY, right? So after the LPSY, what do you guys think we can assume is the LPSY? What do you guys think we can use as a reference point for the LPSY? Well, let's drop to a little lower of a time frame. And let's say we use this inefficiency right up here, right? Which I believe on a 1 hour time frame would be an order block or not. But either way, we can use this inefficiency right here to try to get the 50% of it. So our entry would be around the 50% of this inefficiency, right? So the 50% of this candle. Can I explain inefficiency? Yeah, but it would take a second. So let me actually go to the 30-minute time frame. An inefficiency is basically a candle, right? That is shown to be like a wick like this, right? It's shown to be a wick like this, but it actually mitigates a area to the left. So essentially what's going on here is on a lower time frame, we have an order block here. Right? We have an order block here that is on a lower time frame, and we take the same theory as putting, the 50% of the order block up onto this position. So we're basically taking the 50% of this entry and we're putting it in such a way that it's basically on a higher time frame. It looks like a wick, but we're taking the 50% of it. There's classes on it that we've already done. I can't explain it because it would take too long, but it's essentially this. To not confuse you guys, let me actually just use this one, the one that Hav had said earlier. So myself real quick. Okay. Right here, we see the beginning of a distribution, right? When we see this beginning of this distribution, we see that it created the upthrust, right? And it created the upthrust after distribution. We see the test. So what are we going to do for this test? What do you guys think we're going to do? We're going to look for an entry around that test. Now, since we're going to be looking for an entry around that test, we're going to want to see, around this area where the market is going to react. Why are we looking around this area? Here we have an order block, right? And this order block is going to be our basically our target, right? Because we're going to try to get into this trade around this order block. Now we're going to put, like, let's say a hypothetical position, right? And we're going to say, so where should our target be on this schematic? Our target should be down here. What do you guys think it should be down here? SOW, right? It should be going back to create that sign of weakness, or it could also be, taking out these lows because it is trying to go lower. So because of that, banks are going to be they're going to be trying to push price lower so that they can actually take that position and check whether or not they actually have enough strength, or they have to come back up to pierce, the bottom one more time. So if we see what's going on here, we have the upthrust after distribution, right? We have this test, and then from here, we're going to be pushing back up to get our last point of supply, because banks want what? They want as high as a position as they possibly can to sell their asset. So in this case, if you were a bank, you wouldn't just sell it all the way down. There's too many people following you. So what you need to do is you need to come back up, right? And you're going to have to take more selling positions from a higher price to actually make a lot more money, right? So if we play this replay, okay, well, price barely missed our entry, but at the same time, we see that this LPSY definitely was created, right? So this LPSY definitely was created, and we see that it came back up into premium or higher pricing, right, to give banks higher entries, right? And since they give banks these higher entries, they're going to what do you think banks are doing when they push price up here? So that, remember that banks are buying down here, right? And then banks, what are they going to do up here? What do you think banks are going to do up here? Right, they're going to stack new entries up here at premium. So because of that, what they're going to do is they're going to be stacking more entries towards the sell side, right at this point up top. So I hope this helps you guys visualize what they do in terms of premium pricing. They buy up here and they sell up here. They sell up here so that they can get higher entries. So they create this LPSY on purpose, and that's exactly what the LPSY is expected to do. So whenever you guys are looking at a schematic and you guys are trying to check an LPSY on the later time frames, right? What you're going to be doing is you're going to be trying to find entries at premium pricing that banks are going to head for, because that's what they're going to be looking for, right? They're going to be looking for higher prices so that they can stack more sell entries, if that makes sense. Does that make sense to everybody? Would you say the LPSY is a retest of an order block? Yes. A lot of times it can be. It can be a retest of a breaker, but I don't want to get into more complex explanations because that's more of an intermediate topic. So right now we're trying to keep it for beginners. So now you guys understand distribution, right? Now you guys understand distribution. If you guys were given an example of distribution, you guys would see it. You guys would understand it, right? Or do you guys need some more explanation on what distribution is? I'm gonna try to find another example for you guys. find another example. Yeah, so right here. Go ahead and show you guys this. Let me replay this right here. Here we go. All right. So we see this example here of distribution, right? So we see our preliminary supply, right? We see our buying climax, we see our automatic rally, we see our we see this test, right? Then we see this upthrust, and then we see this upthrust after distribution. So now we drop below, and we haven't really made a sign of weakness. Well, not yet, right? We haven't broken below this floor. And from here, this creates the test, right? Because it comes up and it mitigates this area, and from here it should it should continue going down, either making the sign of weakness or from there expecting a retest. So let's go ahead and play and see what happens. So in this case, we see that the test actually gets mitigated twice, right? The test gets we have the first LPSY here, we have the second LPSY here, and we have the third LPSY right there, right? And from there, I know that I can't zoom in that much because TradingView won't let me, but I know that in this position we're using lower time frame Wyckoff. Actually, let me see. Let me try and see if they can, if we can actually come back and look. Gotta go to the. Yes, it will let me. So, what does this look like to you guys? What does this look like to you guys? These are different lower time frame variations of Wyckoff schematics, right? And they look like distribution. So whenever we entered up off on this position, we're going to get an entry that actually took us, on lower time frames. And I actually explained this in the first boot camp that it takes our position from a higher time frame perspective into a lower time frame perspective. But ignoring that for a moment, we see that in this case, we have a perfect case of distribution, right? That actually came back up and it retested 50% of the order block. So yes, as we said before, LPS wise definitely can be a retest of an order block. A lot of times, one of the kind of like little cheats that I have is usually if I see a really nice distribution, I wait for it to come back up to an order block, or for my more advanced people, a breaker block, right? So that way we can catch as little drawdown as we can. In this case, we see that price continues on lower, right? It creates that SOW, and then from there it actually ends up coming back up and retesting this, dropping a little bit more, and then continuing towards the side. So does everybody understand distribution so far? Cool. Does anybody have any questions that you guys would like to ask? Please make sure you guys are asking now. Okay, it seems that nobody has any questions as I'm looking at the chat, so we're going to go ahead and continue. So that was distribution. Now we're going to do the exact same thing, but we're going to put it in bullish perspective. Price is always similar to this. What do you mean? Via time frames? Um, Can you rephrase your question? I'm not sure I understand what you're saying. Okay, no problem. So let's continue to accumulation. So accumulation is the exact same thing that we just saw in distribution, but inverted, right? It's inverted. So one of the things that is you're going to see is that PS, right? So this is preliminary support rather than preliminary supply. It's literally the exact same thing, just inverted, right? So we're going to have the PS, right? Instead of a buying climax, we're going to have the selling climax, right? So right here, if we annotate this, we're going to have the preliminary supply, right? We're going to have the selling climax rather than the buying climax, but it's going to serve the same purpose as a buying climax. And we're going to have the automatic rally, which is the exact same thing as the other automatic rally. It's the exact same thing. The secondary test, which does the exact same thing as the one that we saw in distribution. So literally the first two phases, right? The preliminary supply, selling climax, automatic rally, secondary test, they're all the same thing in both accumulation and distribution, right? Now, what we have at the bottom here is the spring or the shakeout, right? And the spring or shakeout is the exact same thing as a UTAD, right? Or the exact same thing as an upthrust after distribution. If you were trying to buy a item, you are going to want to buy it as deep as a discount as you possibly can. It's going to save you money. Is the exact same thing with banks. They're going to try to buy it as low as a price as they can so that they can get as low as an entry for buys, right? Because if they buy it very very low, they're going to get a lot more return when they sell it later on. So it's the exact same thing. Then we have the test, right? The test, it does the exact same thing as the previous test. All that it's doing in this case is instead of it confirming the bearish order flow, here it confirms the bullish order flow, right? So what do I mean by bullish order flow? It's the exact same thing as the bearish one, right? It retests that low and it makes sure that it is holding that low and it is going to continue higher from that point. Now the LPS is going to be the exact same thing as the LPSY, right? Except that it's the last point of support, not the last point of supply, but it does the exact same thing. It tests the test, right? So it retests the test and it confirms, right? And that's our entry. So it can retest an order block, it can retest a breaker block, it can retest an inefficiency, which are more advanced concepts. But right now you're just learning the phase and you're learning to spot it, right? So right now you're just learning to spot it. So it's the exact same thing as the LPSY. It does the exact same thing. It retests the test. So this should be your entry, right? And then afterward, we have our sign of strength. So it's not sign of weakness, it's sign of strength, right? And that is when it breaks above this level. So again, it's a prod by the banks, it's a poke by the banks trying to break the roof off, right? So it jumps the creek, right? As classic Wyckoff would say. It basically goes out of the trading range. It breaks out of the trading range. Now, out of this breaking out of the trading range, this is not break and retest. Do not confuse this for break and retest. We do not use break and retest in any way, shape, or form. What it does is after this sign of strength, this photo doesn't really show it as well, but more than likely this sign of strength is going to retrace deeply into an order block and the last point of supply position, or it's going to retest towards a previous piece of structure in which from there it will continue on upward. So it's the exact same thing. Like I said, it's the exact same thing as um, distribution. It's just inverted. So if we take a photo of distribution and we flip it on its head, it's going to be accumulation. It's the exact same thing. So one thing that I struggle with is spotting an order block and what makes one more significant than others if several might possibly be spotted. Several. Usually you don't want to have several. There should usually only be one or two. And if there are several, check which ones have already been mitigated, meaning which ones have already been tapped. And that's more of an advanced topic. So I'm going to do an advanced topic in about 30 minutes. So I'm gonna go ahead and do order blocks and liquidity rating after that. What if what if price wicks the test instead? What do you mean if it wicks the test instead? If it goes below the LPS and tests the wick and tests the test. Can you explain again how you could tell it's already the preliminary supply, or that the distribution accumulation has already started? So as I said earlier, you do not want to classify. Like I said, the biggest mistake that I see a lot of new traders make is you do not want to classify a range, right, or a move as a schematic until you see the shakeout, right, until you see the spring, or you see the UTAD, right, and then you see the test confirm it. Do not call it distribution or do not call it accumulation until you see the test. When you see the test and you see the reaction to the test, then you can consider this a schematic, and from there you can plan your entry, whether that be an order block from the test, whether that be an order block, later on, or an efficiency later on, or a breaker block later on. But you want to only classify a range or a piece of structure as a schematic if and only if you see the spring into the test or the UTAD into the test. That's the only time you want to classify it as a schematic. So what I think I'm understanding from your question, Jacob, it's like if the SOS goes below, it doesn't matter as long as it doesn't break structure, right? So as long as it doesn't break below this, you're fine. So yeah, it's the exact same thing, just flipped on its head. So if we would flip this on its head, it would be the exact same thing. Oh, that's still there. Okay. Let me see if I can find one on USD CAD. Oh no, USD CHF. I think USD CHF should be a good one. I think this was one earlier. Yes, so this is a good example of accumulation. Now, accumulation does not have to completely reverse the trend. All that it's doing is giving you an entry into a new position, right? So it's supposed to give you an entry into a bull, right? So because of that, in this case, we have our preliminary test, right? Established trending range, and then from there, um, from there we see this sorry, this downward spike, and then from there we see this spring, right? And then from there we see another automatic rally that leads into a test, and from this test we get led on into multiple last points of supply. We see this last point of supply, support, sorry, and then from there we shoot up into our move. So our entry in this case would have been this order block. It could have been these smaller, lower time frame order blocks, and that's what would basically would have taken to catch this move up into the bullish position. Okay, so does that make sense to everybody? Okay, so does everybody understand this concept? Does anybody want to go over or re-explain something? Okay, all right. So does anybody have any questions that you guys would like to ask? So the next topics that we're probably going to talk about are most likely going to be order blocks. So if you go to the what is it called, recorded sections, recorded lessons by educator, you should be able to find a you should be able to find a lesson on order blocks and breaker blocks. It's by Garrison, so Gary FX. Okay, you guys should be able to do that. Now, if you guys have watched the boot camp, you have already understood them and you have already watched them, so you already know what an order block is. So that's the next one. The next one should be liquidity and order blocks. Uh, so accumulation and distribution do not have to reverse the whole trend. A lot of times, sometimes they do, but a lot of times they're meant for banks to, collect their own liquidity and then start moving in a different direction. And most of the times they do, but if they appear on lower time frames, they don't have to completely reverse the whole trend. They're just preparing to move in a certain direction. So, like I said, they're preparing to move in a certain direction doesn't necessarily mean that they're changing trend completely. So all it's really doing is giving you a position into bullish or bearish order flow. Exactly. So what you want to use Wyckoff as is kind of like a setup. You know how when you're learning how to bat as a kid, you're using a little T stand. That's the exact same thing you should be doing with Wyckoff, right? It should be giving you a bit of a T for you to hit the ball, whether it be into bullish, accumulation or into bearish distribution. So whether like, let's say you're going up into Euro USD and later on when you understand inefficiencies, right, you take the 50% of this inefficiency and it drops, like 300 pips. You did that because this distribution schematic gave you that T for you to understand the order flow. So it's an easier way for you to understand order flow. It's a way to visualize order flow. It's a way to visualize where you're going to take the trade and where the banks will move next based on previous price movement, if that makes sense. Does that make sense, Daniel? Okay, awesome. Okay, okay. So now that you guys understand what Wyckoff is, do you guys have any other questions before I close out the session? So what I want you guys to do as your homework, right? I want you guys to go and I want you guys to find these out in the market, right? I want you to go and try to find them, post them in the beginner chat, and I'll try to help you and guide you and show you whether or not they are distribution or accumulation in the market, or whether you're trying to call them too early, or whether there's something, different about it. I'll let you know. So I want you guys to go out and practice this in the market, go, scroll back, do back testing, whatever you'd like to do, or look at, charts, and from there post them in the beginner chat so that way I can help you as much as I can. Yeah, so the homework, it's find Wyckoff schematics in the market and post them in the beginner chat so I can help you out. Okay, or you can go back in the charts and try to find them as well. You guys can do that too. Wyckoff is spottable in cryptos? Yes. So everything that we teach is going to be applicable to crypto, is going to be applicable to stocks, is going to be applicable to commodities and forex. It's applicable to any market that is financial, because that's how this trading style was developed by many more experienced traders than us. But yes, it's developed to basically mimic the interbank price delivery algorithm. So, for example, since Wyckoff was firstly made for stocks, right? Um, Whenever you go into stocks and you actually put Wyckoff into play in stocks, you are going to see a massive return, right? And from there, you're going to also see, like, for example, commodities. You're going to find a lot of order blocks in commodities. So if you go to commodities someday and you start trading commodities, look for those order blocks. You're going to find a lot of inefficiencies there too. And it's the exact same thing for crypto. Crypto, you'll find a lot of market structure. So market structure is your best friend in crypto. So like if you would have wanted to catch all of these, massive moves, more than likely there would have been a Wyckoff schematic on lower time frames to show you that. I'm pretty sure I found Wyckoff in the Guild Wars 2 MMO trading post. I have no idea what that is, but I'm glad you found it. So yeah, I appreciate everybody. Oh, one more question. How long did it take you to know Wyckoff schematic without guidelines, labels to it? So don't be afraid of it for you to take a bit. The difficult part about you learning how to trade is training your eyes. Okay. So the difficult part about learning how to trade is training your eyes. Because if you want to train your eyes, it's going to take a while. Okay. It's going to take a while for you to train your eyes because you have to look at this a certain amount of times. Right. So if you see distribution here, perfect. Go to another chart. You may see distribution on lower time frame. Perfect. You may be struggling with looking at accumulation. For me, accumulation was hard to spot because I didn't know whether or not it was just continuing down or it was actually creating a range. So I challenge you to try to do it, right? It's kind of like training wheels. So the schematics, the labels, right, are meant to be your little training wheels. But then afterward, you can start taking them off and you'll just see, this part of the schematic and you'll say, okay, well, I already know what this is. So you'll just kind of start like labeling it as like the first part of the schematic. And then you won't even need to think about it. All that you'll be looking for is the up thrust, the UTAD, the test, and then from there you'll be looking for your entry at your LPSY, right? So how long did it take me? It took me a couple months. It didn't take me that much because I was sitting at my computer all the time at that point. But it took me a while. It took me a second to actually memorize them and use them specifically. It took me about like 2 months to then finally use them like very efficiently. So it should take you around that time. And if it takes you a little bit longer, that's completely fine. There's no shame in it because I was literally up every single London session. So trying to study as much as I could about like 2 years ago. So yeah, guys, I appreciate you guys being here. And oh, whoops, there was one more question. Um, gotta burn Wyckoff schematics into your eyes. Yeah, just like you gotta burn, order flow, just like you have to burn bank orders, right? So bank orders is one of the biggest things that I see a lot of students struggle with, bank orders, because they start trying to visualize bank orders and they get confused, right? Because they're just like, I don't know where I'm going. I don't know where this is going, but later on you'll learn it. So try to come up with a method of memorizing things that is best for you. So for me, it's better for me to have like a little word bank like right next to me. So like I have a sheet of paper saying like PSY, then like the definition, the automatic rally, and then the definition. All of these things in like little definitions, and you can make little post-it notes and like put them on your monitor and say like, okay, here's one, here's two, here's three, here's four, here's five, here's six, and then take a picture of it, send it to Discord, and then I can check and see like if your labels are correct. Another way that you guys can do it is you can do the same thing on TradingView. Or another way that I used to do it is I would draw up kind of like a key, right? So I would draw like what a perfect accumulation or perfect distribution would look like, and then I'd match it up, right? I'd look at my chart and I'd look at my piece of paper and I'd try to see, well, does this one match? Yes, kind of. And the person who taught me, right? So I would go up to them and I'd be like, "Hey, can you show me like is this correct or is this not correct?" But the key was asking questions. The key was asking questions. He couldn't read my mind. So he wasn't going to come up to me and say like, "Oh, well, I see that you're looking at no." Right? Your mentors can't do that. So if you want to learn and you're serious about learning, I suggest you ask questions. And even if you just want to copy and paste, you need at least a little bit of basic knowledge for you to copy and paste, right? And so that's completely fine. Priceless. No, I actually have one more class in about 30 minutes. So you can hop onto that one. It's more of an advanced class though. So if you're interested in advanced topics, you definitely can drop in and get some advanced knowledge. All right. No problem, guys. No problem, guys. I appreciate you guys hopping on. Thank you guys for your time. I seriously appreciate all of you guys for your time. So thank you guys so much for watching. I hope you guys have a good night. And if you guys are hopping on to the advanced class, um, that will be active in about 35 minutes. All right, guys. Take care.